None of this is intended as financial advice. I'm simply a dude on the internet. You're responsible for your own decisions. So, in today's video, I'm going to show you why I think that Bitcoin won't make new lows nor go below 16K in this cycle. The bottom is in. The bull market has started as the lows are already in, and that's when the bull market starts. Now, on this chart, we have the halvening events and the projected halvening happening in 2024. We're expecting it in April, so I plotted the line there for us. Now, what we're going to do is do a Fibonacci time analysis. Now, we're only using the 38.2, the 61.8, the 78.6 level, and the extension of the 1.382. So the 61.8 is your pink line, the 78.6 level, the blue line, and then the extension, the 1.382. You can see the fib levels at the bottom here. Now from the one halvening to the next halvening, we can see that when the bottom is in the 61.8 prints, you've got your accumulation phase between the 61.8 and the 78.6 level, and your extension ends, your time zone ends at the next halvening. This projects the next top within 2 months. So that is the 1.382. That projected the top within 2 months. So if we move this and then project it to our next cycle, we can see some of these patterns repeating. The 61.8, when it's printed, you have your bottom coming in 2 months later. You have the end of your accumulation phase by the 78.6 level. You make a higher low and then you head off and you print your high once again within 2 months after the 1.318 has printed. Now let's do that again with the cycle that we are currently in. So from the previous halvening all the way to the next halvening happening in 2024 in April, we can see that once again, once the candle, the 61.8 prints, 2 monthly candles after that, we have our bottom coming in, the end of the accumulation phase, which is the 78.6 level. So pretty much everything has coincides with previous cycles. The reason why this won't make a new low is you would nullify this whole accumulation cycle and the bottom. That would mean another accumulation phase would need to happen, which would take you well past the halvening, throwing this whole cycle into disarray. The top for the next cycle, a little bonus in this video, is the 3rd of November 2025. If you like these kinds of videos, please do subscribe, hit the like button. It is really appreciated and it costs you simply nothing. So if we go off this cycle analysis, we can't expect Bitcoin to go lower and start breaking this structure that it's built. It doesn't mean it can't go lower because we've been moving sideways and down for a little bit of a while. These are our higher lows here. We want these to be defended, otherwise that would not be positive. Like I said, if you start breaking this market structure, these higher lows that you have here, it can't recover in a massive wick like it did with the zombie dump over here. Generally, you need these higher lows to hold, and even this dump from the virus that still respect these lower highs, these higher lows down here, excuse me. So maybe we come to retest this 25k level, but we really want these two higher lows to be respected. So let's jump right into the next chart. So this is the reverse repo. The reverse repo agreement. This is a short-term agreement to sell securities in order to buy them back at a slightly higher price. It is the opposite of a reverse repurchase agreement, which is called repo, where one party buys securities and agrees to sell them back later, this being the Fed, right? And they sell to smaller banks. RRPs are used by financial institutions to park their excess reserves at the Federal Reserve overnight and then earn interest. Risk assets, your stock market, crypto, Bitcoin, have a higher return but also higher risk, such as stocks, commodities, crypto, etc. The relationship between RRPs and risk assets, it's not that straightforward, but one explanation is that when the Fed offers a higher interest rate on reverse repurchase agreements, it attracts more funds from financial institutions, reducing liquidity in the market and making risk assets less attractive. Conversely, when the Fed lowers the RRP rate, it encourages more lending and investing in your risk assets. So the blue line is the repurchase agreement, and we can see how it's been falling off a cliff. Now it's just to remove the S&P to show our risk assets, and it's starting to turn over. This is the daily chart, the daily line chart, and not many people are looking at this as there is more liquidity that the Fed is leaving in the market, encouraging more risk taking, more lending from the institutions, from the banks. Now, if we put the S&P over this, we can see that it started going up with it. And when this started to get really exaggerated, we went into our bull market, right? And right at the peak here, at $2.43 trillion, the stock market started to bottom. You can even see the spike here all the way up to 2.5 gave you this dump in the stock market as well, testing the lows and creating a higher low. And then another spike, another dump, another higher low on the stock market, and off we go. Now this has now accelerated, and the stock market really hasn't caught up to what is going on. The reason I put the stock market is here. As soon as we start breaking all-time highs, only then can we really expect the more riskier assets like crypto to really catch a bit in the market, because the traditional investors will have to increase their risk appetite once the stock market starts hitting all-time highs, because many of them have already missed this massive rally of the lows. Everybody is still calling for a recession, for doom and gloom, and it has already taken off. Now this has probably already been the recent low here. Maybe we come down to retest it, create a little W before pumping off. But you can see there's lots more liquidity in the market, encouraging the banks to start lending out. This can also be front running the interest rates, and the market is expecting the interest rates to, actually we can quickly take a look at it, that the Fed will pause pretty soon. We can see there a 93% chance that the market predicts that Jay Powell will pause. This is the meeting in the 20th of September. This is the second pause of the cycle. So we can see more liquidity in the market, and it works conversely to what the stock market does. So this is going to continue going down, as this doesn't look like it wants to stop anytime soon. You see how violently it goes up and violently it goes down. Next, the dollar index. The reason why everything is kind of struggling right now is because the dollar is showing quite some strength. Now it's currently rejecting today, and this does look like a top. If we look at these indicators, there are bear indicators. This is the Willy. It's just a faster version of the RSI. And we can see when it starts printing these red bull channels, it starts going down, rejecting, and the previous stop up here. So maybe we come down a little bit more. This is a bottoming structure for the Dixie, and it doesn't mean it can't rally with Bitcoin, but maybe a little retracement giving us our bounce in the crypto market, and then upwards in the future. All the way back here, it was all the narrative that the dollar is dead, etc. And yeah, off we go from the lows. dollar crushing all of the forex and some of the risk assets as well. Now, the reason I'm going to clean up this chart a little bit. This is the weekly, and this is the US dollar, the US oil market. And as soon as the oil market exceeds the $77 mark, it puts a lot of pressure on the risk assets and inflation, as well as pretty much everything that needs to, every product that needs to be transported needs fuel, right? 4% of the economy is renewable energy in America. The rest is all on crude. That's flying, transport, pretty much everything, right? Cars. And we can see that if we zoom out a little bit, how your risk assets, we can see here when oil bottomed at 66, it was the top, coming down all the way down, down, down. And now crude has been taking off, putting a little bit pressure. We can see up here how it's putting pressure on the risk assets. It bottomed, topped here a little bit, and the risk assets S&P had a little bit of a bid, and price reversed, and now we're seeing a lot more pressure on the stock market. It can go up with it, but generally it does start to eventually suffer a bit under the pressure, and that's what we're seeing now, the pullback in the S&P. Now this is a little bull flag that's creating here. I'm expecting a little bit, maybe one more leg up higher before a correction here, and this would also give a lot of relief for the crypto cycle and cryptocurrencies as well, for the prices. So let's see, it looks like the Dixie and the oil does want to go a little bit higher. This puts in this low here. If we can defend that low here at 2,456, that would be perfect, and we can rally, or even if we just move sideways here into April of 24 for the halvening, that would be fine as well. Technically, this is still the accumulation phase, and the massive bull run actually only starts during the extension all the way to the 1.382, all the way to November of 2025. So most of the action is going to be happening in this area, not right here, right now. This is the slow and the boring part. Views are down, engagement is down, not many participants in the market, but you're starting to leave your accumulation zones. We are technically still inside of it. Bitcoin is still in value here, but time is running out. And Gann, WD Gann, very probably one of the better traders that's ever lived, said that when the time is up, the price will change. And we're running out of time for this market to make a new low. And if that happens, there would be something very fundamentally wrong with cryptocurrency. And that would be pretty catastrophic. And if you're rooting for that, you're rooting that there won't be a cycle this time. So that being said, thank you for watching. Always do play from a position of strength. Don't get wrecked. And I will see you guys in the next video. Cheers for now, and bye-bye.